The current trading price for Walmart Inc. is sitting at exactly 106.30 USD, marking a massive intraday surge of plus 5.69 points, or a 5.66% gain on the session so far. This is not just a standard green day. This is a gap-up breakout of significant magnitude for a company of this capitalization. The market is open, liquidity is flooding into the ticker, and the tape is moving with a ferocity that suggests this is not merely retail enthusiasm, but a coordinated institutional accumulation event. If you are watching the charts right now, you are seeing a definitive change in character for the stock, pushing through psychological resistance levels with volume bars that are towering over the 20-day average. The expectation for a company like Walmart is typically one of slow, defensive stability, a stock you park cash in to weather a storm, not one you buy to chase aggressive alpha. The expectation is that in a high-interest or uncertain economic environment, a grocery giant simply grinds out low single-digit returns while paying a dividend. That is the comfortable narrative that most of Wall Street has sold for the last decade. But here is the reality that is playing out on your screen at 106.30 USD. Walmart has effectively shed its skin as a brick-and-mortar relic and has revealed itself to be a high-growth technology and media platform disguised as a supermarket. The price action today is not reacting to the sale of milk and eggs. It is reacting to a fundamental repricing of the company's profit engine. The reality is that Walmart is posting growth metrics in its advertising and e-commerce divisions that rival Silicon Valley darlings, and the market is finally waking up to the fact that this stock has been misclassified as a value trap when it is actually a compounder entering a new phase of margin expansion. This tension between the boring retailer everyone thinks they know and the data-driven logistics powerhouse that just reported earnings is precisely why we are seeing this vertical move today. Let's examine the immediate market mechanics driving this 5.66% move. At the open, we saw a massive influx of buy orders that cleared out the ask side of the order book almost instantly. This kind of price action usually indicates that large funds were caught offside or underweight and are now scrambling to build positions. When you look at the volume profile, the activity is not just concentrated on the retail side. We are seeing block trades executing at the 106.00 level, suggesting that smart money is defending this new price floor. If you are trading this on a Fidelity mobile app or checking your Robinhood stock trading account, you might see the percentage gain and think you missed the move. However, seasoned traders know that when a mega-cap stock like Walmart breaks out on news of this caliber, it often signals the start of a trend, not the end of one. The momentum we are seeing is being fueled by a short squeeze of sorts, not in the traditional sense of high short interest, but in the sense that portfolio managers who were underweight Walmart in favor of tech are now forced to rotate capital into WMT to avoid underperforming their benchmarks. We need to talk about where this capital is coming from. In the current market environment, we are seeing a rotation. Investors who have been heavily concentrated in semiconductor names or volatile software stocks are taking profits and looking for a home that offers both safety and growth. This is where the conversation about online investment and self-investing becomes critical. Retail traders using a SoFi trading platform or managing a Schwab Intelligent Portfolios account are often looking for that perfect middle ground, a stock that won't keep them up at night but still offers price appreciation. Walmart at 106.30 USD is hitting that sweet spot today. It is capturing flows from the defensive sector ETFs, but it is also attracting growth capital that is impressed by the double-digit expansion in its digital channels. You can see this dynamic playing out in the options market as well, where call volume has spiked significantly, particularly in the near-term expiries, indicating that traders expect this momentum to carry through the end of the week. So, what triggered this explosive move? The catalyst is the Q3 FY26 earnings report, which hit the wires just before the bell, and the numbers are nothing short of a mic drop to the skeptics. Walmart reported revenue of $179.5 billion, a beat that signals the consumer is far more resilient than the bears predicted. But the headline revenue number is not the real story. The real story, and the reason the stock is up over 5%, is the composition of that revenue. E-commerce sales surged 27% globally. Stop and think about that for a second. For a company the size of Walmart to grow its online business by nearly 30% is a staggering feat of logistics and consumer capture. It implies that they are not just holding their own against Amazon, they are actively taking market share. This growth was driven by store-fulfilled pickup and delivery, a model that leverages their thousands of physical locations as many warehouses, drastically cutting shipping costs and improving speed. Even more impressive, and the metric that likely has institutional analysts revising their price targets upward, is the growth of Walmart Connect, their advertising business. This division grew 53%. This is the hidden gem inside the massive retail empire. Advertising margins are typically 70 to 80% compared to the low single-digit margins of retail grocery. As this segment becomes a larger portion of the total revenue pie, Walmart's overall profitability explodes. This is the realization that is hitting the market today. Walmart is slowly morphing into a media company that sells groceries to acquire audience data. When you utilize investment help services or read reports on investing sites, they often overlook this internal transformation, focusing too heavily on same-store sales. But the smart money using an interactive brokers trading platform to analyze segment data sees this margin expansion clearly. They realize that every dollar of ad revenue is worth $10 of grocery revenue in terms of bottom-line impact. The narrative gets even deeper when you look at the leadership dynamics. With CEO Doug McMillon preparing to pass the baton to John Furner, there was some trepidation in the market about continuity. However, these results solidify that the strategy is working and that the transition will be seamless. Furner has been instrumental in the digital transformation, and the market views his ascension as a doubling down on the omni-channel strategy that is clearly winning. This removes a layer of uncertainty, allowing investors who were sitting on the sidelines to enter the trade with confidence. Whether you are using a Fidelity brokerage account for your retirement or playing short-term swings on a Robinhood app, the removal of leadership risk is a massive green light. We must also address the macroeconomic angle that is fueling this rise. There has been a long-standing debate about the health of the American consumer. Are they tapped out? Are they drowning in credit card debt? Walmart's results offer a nuanced answer. The consumer is discerning, but they are spending. Interestingly, the company noted significant market share gains among upper-income households, those earning over $100,000 a year. This is the trade-down phenomenon in action. As inflation keeps prices high elsewhere, wealthier shoppers are swallowing their pride and heading to Walmart for groceries and essentials. This demographic shift is powerful because these shoppers have larger baskets and are more likely to purchase higher-margin general merchandise. It fundamentally changes the customer lifetime value models that analysts use. If Walmart can retain these high-income shoppers even as the economy stabilizes, they have effectively upgraded their entire customer base. Let's take a moment to look at the technicals on the chart at this very second. We are trading in blue sky territory, near all-time highs. When a stock breaks out into a range where there is no historical resistance, no bag holders from 5 years ago looking to sell at break-even, price discovery can become very aggressive. The Relative Strength Index, RSI, is pushing into overbought territory, but in a strong trend, stocks can stay overbought for weeks. The Moving Average Convergence Divergence, MACD, has just crossed bullishly on the daily time frame, confirming the momentum. If you are looking at a Fidelity trading platform or analyzing charts on interactive brokers, you will see a classic volume shelf forming below the current price, which should act as strong support if we get a pullback. The $100 level, which was once a psychological ceiling, is now the new floor. Traders who use Robinhood fractional shares to dollar cost average into positions should be watching the 102-103 zone as a potential buy the dip opportunity. Though with this much momentum, we may not see those levels again anytime soon. Now, let's pivot to the broader business model for those who might be new to this ticker, or who only know Walmart as the place to buy cheap socks. Walmart is the world's largest retailer, but describing it that way is a disservice to its complexity. It operates a massive network of hypermarkets, discount department stores, and